The right to disconnect laws create confusion and anger in the business community with warnings of an end to flexible working. Bitcoin surges to its highest level in a couple of years, and CSL's $1 billion failure. Welcome to Fear and Greed Business News, Australia's best business podcast. It is Tuesday, the 13th of February 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. CSL's $1 billion failure. Well, we better get into that a bit later on. I don't know, maybe that's a bit rough calling it a failure, but, spend $1 billion on something that doesn't work. Not many companies can do that.
Yeah, you're right. I'm looking forward to the details on that one. We'll get to that in a little bit. You've also got a great interview coming up after the show today with Damon Kitney, one of Australia's leading business journalists.
Yes, so we talk about the cult of personality, the cult of the CEO. Ad man and philanthropist Harold Mitchell died over the weekend, leaving an enormous legacy. He was larger than life, and particularly in his early days, he was, as Damo says, literally larger than life. We're asking about Harold as well as other high-profile CEOs like Alan Joyce, and whether or not investors like seeing those types of people as CEOs anymore. It's a fascinating chat. We go through a bunch of people who Damon knows very well because he's interviewed them all. In fact, he's got a book out on it. And it's fascinating, his insights into those types of people.
Yeah, it is great. As you say, he does know them all. He's spoken to them all. He's interviewed everyone. He knows this space so well. It is a fantastic chat. It is well worth a listen. Coming up a bit later on, it's coming up after the show, Sean. The main story, though, this morning, the right to disconnect laws set to pass Parliament are finding some very vocal opponents with claims that they'll sap productivity and workplace flexibility.
For example, the head of Woodside's Human Relations, Julie Fallon, said the new laws will make it difficult for companies working across multiple time zones. She also said the government's same job, same pay laws passed last year were difficult to navigate when contracting out work. Woodside wants it to fall under service provision rules, not labour hire. It makes scoping out hiring just that much more bureaucratic. It's interesting, across the time zones, I hadn't thought much about that, but that is going to be a real problem for companies. Australian Industry Group Chief Executive Innes Willox said the right to disconnect will diminish flexibility that workers currently enjoy. He told The Australian that the new laws meant leaving early to pick up the kids or to go to the dentist or whatever will be harder. Australian Chamber of Commerce and Industry Chief Executive Andrew McKellar said businesses are in uncharted waters in this area. The flip side was ACTU Secretary Sally McManus. She said the right to disconnect laws would ensure balance and flexibility by enabling negotiations between workers, their unions and employers to tailor what's reasonable. Under the industrial relations rules, workers will be able to take their employer to the Fair Work Commission if they are punished for not responding to out-of-hours contact. Now, the industrial umpire will adjudicate whether the employee was being unreasonable in refusing to respond to their boss. Bosses face potential fines if they continue to try to contact the employee after the hours. The point of that is it's not that clear-cut how this legislation is going to work, and that will also cause problems both for employees and employers.
It was always fairly inevitable, wasn't it, Sean, that with a change of this kind of scale, that there was going to be a fair response from the business community. But this is a lot of voices all speaking out at the same time.
Yeah, it sure is. And I mean, we're seeing it in Canberra. That's obviously the hotspot for it, politics particularly. Very much it's the focus of the opposition's attack on the government, with opposition leader Peter Dutton vowing to roll back the right to disconnect laws if elected at the next election. He also wants to roll back other elements of the new workplace regime. It's pretty clear the next election will be fought over two big issues: industrial relations and tax. Peter Dutton's been using the line that the government has outsourced its IR and economic policy to the Greens. Prime Minister Anthony Albanese has been appealing directly to workers, saying that the opposition wants lower wages, more taxes on low and middle income Australians, and wants to wind back reforms that are in the interests of working people. So, with the next election due, it's probably early next year, 12 months, let's say. The campaign has already started. Taxes and IR, Michael.
Yeah, it certainly has. Sean, one of the many, many lessons that I have picked up from you on this podcast is that, above all, business needs certainty. So what does this mean then for businesses who are now going into kind of say the next 12 months going, we don't know whether these laws are actually going to be around kind of in 18 months' time?
Yeah, they will work with what they've got. So once they're legislated, they've got to change their behaviour to suit the legislation. So they will have to change their behaviour around the right to disconnect, and there will have to be policies around that. There'll have to be policies around the other IR reforms. Whether or not Dutton actually goes ahead and does that and repeals them if he wins, that's kind of a secondary issue at the moment. I think what's really hard for them, and the HR person at Woodside said it yesterday, it's just how these actually work in a pragmatic way. That's what's going to be really hard for businesses.
All right. Now, Sean, local markets, how did they perform yesterday?
The S&P ASX 200 closed down 0.4% to 7,615 points, with the healthcare stocks weighing on the sector. Very much that's a story of CSL, which we'll talk about in a moment. The tech stocks outperformed. In terms of major companies, the miners and banks were mixed. ANZ was up more than 1%, while Woodside was off more than 2%. Troubled data services company Appen will cut further costs out of its business, including closing its Toronto and Bellevue offices in North America after losing a key contract with Google. That helped the group's share price jump 14%, though it's still down more than 50% in the past 6 weeks. Fletcher Building share price fell 6% ahead of tomorrow's results. It announced a review, including a cryptically worded comment on the building company's CEO and his future. Didn't even realise that was up for discussion. Anyway, worst in the day was lithium group Liontown Resources. It was down 8%. Now, over the weekend, a 4-month clause hampering mining billionaire Gina Rinehart from lobbying a takeover bid for Liontown Resources lapsed, and nothing came. She didn't make a bid, hence that pushed down the share price yesterday.
And what's happening in international markets?
Inflation figures due out this week in the US are pretty much dominating discussions in offshore markets. There's also retail sales figures and consumer confidence data in the world's biggest economy in a few days' time. Oil prices are off for a bit, with hopes that the Israel-Hamas conflict is moving closer to a diplomatic solution. Many Asian markets were closed yesterday for Lunar New Year holidays. Gold prices are a bit higher. The Aussie dollar's doing nothing, Michael. Absolutely nothing. 65.3. US cents. I tell you what is doing something.
Yeah,
cryptos, Bitcoin. Pretty interesting at the moment, trading around $48,500 a unit. That's its highest level since early 2022. It's now risen for 7 straight sessions. That's the longest streak in a year. Now, we had the Bitcoin ETFs being launched in mid-January. The cryptocurrency spiked, then fell back. Now it's back at new multi-year highs. Why? Well, it's a hedge against inflation, though inflation's falling, so that's not a great reason. It probably does better when the economy looks okay, and that's the case in the US and Australia and plenty of other places. But the main reason for the rise is the launch of the ETFs and flow of institutional money into them. 9 new spot Bitcoin funds began trading on January 11. They've attracted more than $9 billion so far, according to Bloomberg. Also, and this reason's just a little left field, but I like it, sentiment towards Bitcoin is normally pretty good during the Lunar New Year.
Oh, there you go. Wouldn't expect that to actually have an impact.
Well, astrology is not a bad way to invest. I don't mean that. I take it back.
Feels like a very good time to remind everybody that we are not,
certainly
not an investment podcast.
I've just proven it.
And you need to get professional advice before you make investment decisions, not doing it based on astrology. Goodness me. All right, we'll be back in a moment with the rest of the day's business news. Sean, JB HiFi has delivered better than expected earnings, even though profit was down nearly 20%.
Because companies like JB HiFi give guidance throughout the year, earnings season is about whether companies can beat, match, or miss guidance. And in this instance, JB HiFi beat guidance, pushing its share price up more than 1%. Chief Executive Terry Smart described the retail environment as challenging, with sales growth in January up 2.5% from a year earlier, while turnover at subsidiary, The Good Guys, was lower than last year. The group continues to have a dominant market position with younger, tech-savvy demographics, though increased discounting for the 6 months to the end of December hurt the bottom line, which came in at $264 million. Like last week's retailers that reported, JB HiFi looks to be managing the downturn in the economy pretty well. Its share price jumped 7% yesterday, so investors obviously liked what they heard.
Now, Sean, we mentioned at the top of the show CSL, and the company's share price fell more than 5% yesterday after it said a phase 3 trial of a drug to treat second heart attacks has been abandoned.
Second heart attacks account for a large share of cardiovascular deaths, and the trials didn't achieve the aim of showing it could reduce major adverse cardiovascular events. That's what the company said, i.e., didn't work well enough, basically. The CSL 112 drug was supposed to be a blockbuster for the healthcare company, but it just came up short. Now, CSL spends about 10% of revenue on research and development. That's a lot of money, particularly for an Australian company. It spent around $1 billion developing this drug. To get to phase 3 trial phase means you've done a lot of work to get there. I think that $1 billion in this drug is the most amount of R&D money that CSL's ever spent on a drug. Hence, a big disappointment for CSL yesterday. Now, they said the trials could still yield useful lessons for the company's cardiovascular and metabolic drug development programs, but it does demonstrate that in big pharma, there can be a lot of heartbreak. CSL releases its half-year results today.
Yeah, it's interesting, isn't it? And you've mentioned this before. You've spoken to a number of kind of biotech and pharmaceutical companies on the show before. And whenever they talk about phase 3 trials, you suddenly realize just how many steps they've had to go through, how much money has been poured into this, and how many successful kind of tests and trials have actually been kind of achieved in order to get to that point, that it really is a significant milestone.
Yeah, it sure is. And to get to this, basically the final hurdle, and to have to pull the pin on it would be very, very disappointing for CSL. We called it a failure. I mean, I think that's unfair. I'm proud that an Australian company like CSL spends 10% of its revenue on R&D. I mean, that's kind of putting its money where its mouth is, and CSL have always been very good at that. So it's probably unfair to call it a failure because that's just the nature of the industry it's in.
And it's always interesting as well. You hear some fascinating stories about some of the other things that emerged from these trials, like unintended kind of side effects or just other things that they were just also monitoring. And suddenly what was intended to be the primary kind of result or the primary treatment with that drug might actually end up being kind of something secondary, and that the main focus is something else. So you kind of never know where this is going to go. But as you say, just amazing to see $1 billion actually being spent by an Australian company.
Yeah, indeed.
Now, Sean, Car Group, which was previously known as Car Sales, has recorded double-digit revenue and earnings growth after completing the acquisitions of US-based Traders Interactive and Brazil's Web Motors last year.
Yeah, that was their big play. In fact, we spoke to the chief executive, Cameron McIntyre, last year about this. Yesterday, he said customers continue to prioritise premium advertising products in a more challenging macro environment. He said the auto market is resilient despite cost of living and higher interest rate pressures, with traffic and inquiry volumes to carsales.com.au in December all tracking above a year earlier. McIntyre, when asked about new emissions standards, said it's important that manufacturers are given time to adjust. Now, this is kind of interesting because obviously manufacturers in Australia, as they do around the world, have to reduce emissions. A problem for Australian sellers and manufacturers, or our cars are manufactured overseas, is that the Australian market is just small. So it's not like Ford is going to spend huge amounts of time on the Australian market. Also, we're a right-hand drive market, and that actually makes a difference. The risk is that consumers end up with less choice. Anyway, the company share price closed up 1.5% yesterday. Over the past year, though, it's up close to 50%.
Sean, Haulage Group, Horizon, yesterday announced an 82% jump in the half year and has dangled the carrot of higher dividends in the future.
Now, I love Horizon, and I'm about one of 3 people in the country who really likes to get off on Horizon. Oh, I shouldn't have said that. That's a bit much, isn't it?
I'm the second one. I am
second.
So there's 2 of the 3 people who find this very, very, very interesting. I just love trains.
Horizon just shifts stuff around the country, mostly by rail, as you say, like grain or iron ore or clothes or stuff like that. I think that's really cool. Now, it may not be the sexiest business to many, but to you and I, love it.
It's very erotic.
Oh, very. Horizon, the erotic horizon, very vital part of the economy. Now, pre-tax earnings are up 26% thanks to higher coal haulage volumes. Do you reckon coal haulage is erotic?
I think if it's got a train, yeah. It's got a certain charm.
Okay, so pre-tax earnings were above expectations. Another highlight of the result was what's known as access revenue. It's basically money made by providing access to its rail network in Queensland. Horizon used to be, I'm probably going to get this wrong, but I think it was called Queensland Rail. So that's actually where its origins are from. It's now leasing out the rail line, so it gets a revenue stream from there. Not so strong was containerised freight business. That's mostly carrying clothes and food and machinery across the country. Anyway, Horizon's share price closed up 3.5%, which I think is a decent return for an erotic company like Horizon.
Beach Energy was another to report, and it posted a 10% drop in first half pre-tax profit, though the bottom line was a loss thanks to big write-offs.
It had to write down some of its oil and gas fields in the Cooper Basin, as it had announced in January, and the group's share price rose more than 3% after the announcement yesterday. This is back to what I said at the beginning when we're talking about JB Hi-Fi. Companies either miss, match, or beat expectations. In this case, even though there was that massive write-off, Beach Energy beat expectations. Kerry Stokes' Seven Group is Beach's largest shareholder. And yesterday, Chief Executive Brett Woods said it was an exciting time for the company with growth projects close to starting production. Woods, who is new to the role, also announced a strategic review with the aim of cutting costs and lifting returns. Wouldn't you love to see a strategic return where there wasn't the aim of lifting returns? We are doing a strategic review to reduce returns to shareholders.
Yeah. Our strategic review focuses on spending more money.
That's right. Yeah.
It's not going to happen.
No.
All right, let's get to international news now. And US President Joe Biden and his top aides are closer to a breach with Israeli Prime Minister Benjamin Netanyahu than at any time since the Gaza war began, according to media reports.
The US leadership no longer views Netanyahu as a productive partner who can be influenced even in private, according to a report in the Washington Post. It's a critical point in the conflict in the region because the US has proven Israel's staunchest ally. The mounting frustration with Netanyahu has prompted some of Biden's aides to urge him to be more publicly critical of the Prime Minister. He's known Netanyahu for 40 years, Joe Biden has. He's never been critical of him, but some of his aides want him to be. Netanyahu has angered US officials on several occasions in recent days. He publicly denounced a hostage deal while Secretary of State Anthony Blinken was in the region trying to broker an agreement. He announced the Israeli military will be moving into the southern Gaza city of Rafah, a move US officials have publicly opposed. And he continues to say Israel won't stop fighting until it achieves total victory. Not helpful when you're looking for a ceasefire.
And Sean, Donald Trump has been very vocal about his dislike of NATO, suggesting that Russia could bomb US allies who don't stump up funds for defense spending.
Even in the Donald Trump spectrum of silliness, this is right at the edge. At a rally in South Carolina, Mr. Trump recounted a story about an unidentified NATO leader who confronted him over his threat not to defend members who failed to meet the Transatlantic Alliance's defence spending targets. Mr. Trump said he told that NATO leader that he would, in fact, encourage Russia to do as it wishes if a NATO member doesn't pay up. Vlad, go ahead, bomb them. They're just an ally, but they haven't paid their bills. The alliance, which Trump has long disliked, is bound to collectively retaliate if any other member nation is attacked. The UK, France, Germany and Poland are all members. Now, NATO Secretary General Jens Stoltenberg said any suggestion that allies will not defend each other undermines everyone's security and puts American and European soldiers at increased risk. Indeed it does. Donald Trump, this was a good one.
Oh, it's pretty extraordinary. And Sean, your homework for tomorrow is to go and watch some of the ads from yesterday's Super Bowl.
Yes. Did you watch the game itself?
I watched parts of it, actually, which is kind of a first for me because I typically haven't, but I was kind of drawn in by the hype this year.
Yeah.
How about you?
Well, I thought Usher was a highlight. clearly. The only thing no one talked about in the lead up was Usher at halftime. There was a big announcement from Beyonce. That was very exciting. Do you know what that was?
New music.
Right. Yeah, I just saw a big announcement from Beyonce and then skipped that headline and moved on. So I have no idea what the announcement was. As you know, I'm a Patrick Mahomes fan. He's the quarterback for Kansas City Chiefs, and he did what he does best and got them out of trouble, got them the win in the dying seconds, and I watched a lot of it. Thought it was a great game. Lovely to see Tay-Tay and Kelsey so in love at the end of the game. Really, wasn't it?
Really, and that's what everyone came to see. A love story, wasn't it?
It was a love story in red and black.
There we go. Excellent. Please report back tomorrow. All right, up next is the Fear and Greed Daily interview. You are speaking, of course, with Damon Kitney, one of Australia's leading business journalists. It's a great chat.
It is. We start off talking about Harold Mitchell, who is a larger-than-life character who unfortunately died over the weekend. A great ad man, a great philanthropist. Then we talk about the cult of the CEO and how popular that was in the 80s, 90s, even the noughties, but how now investors don't like it.
Yeah, it's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Tuesday, the 13th of February, 2024. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X and Facebook. I'm Michael Thompson and that was Fear and Greed Business News. Have a great day.